Hey, what's up guys, John here. What happened yesterday in the U.S. Treasury market says everything about where interest rates are going.
The session began with a weak auction of 30-year Treasuries, pushing yields higher and stocks lower. Then came remarks from Powell, who said central bank officials are not confident that rates are high enough to tame inflation.
Despite holding interest rates steady over the last few months, the head of the Federal Reserve now says he is keeping the door open for more interest rate hikes.
We are not going to see a Fed pivot anytime soon. In fact, we're likely going to see 10% mortgage rates. We're going to see credit card interest rates at levels in which many people can't comprehend. Borrowing costs are going to continue to go up and credit conditions will tighten. I believe this will present one of the greatest investing opportunities of all time as we start to see less buyers available to invest and many more sellers forced to sell. I'm going to break this down. I'm going to show you the facts. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate the people about what's really going on. And if you'd like to fix your credit to position yourself for the greatest wealth transfer in American history, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Take a look at this. So, Wall Street Journal. Demand for 30-year Treasury proves weak, sending yields surging. I mean, look at this. Parabolic. The 30-year U.S. Treasury yield climbed above 4.8% on Thursday from 4.655% the prior day after a sale of $24 billion in bonds received far less demand from investors than the government is used to. And now they don't want to buy this because they're looking at America's debt as America as a whole as much more risky, right? And so they want a much bigger return for them to make these investments. And because of it, they're just pulling back. And as they're pulling back, what's ultimately happening? Interest rates are going to continue to rise, meaning borrowing costs for Americans will continue to rise. But if you look at some of these, newfound changes that are going to be happening in America, for example, like this here, we're going to be doing this green transition, right? They're saying $275 trillion in costs over the next, call it 27 years, right? So when you're looking at this situation, how is this going to get funded? Well, we're going to need to sell debt. We're going to need to increase taxes. All of these different things are going to be coming, right? Well, when other countries start to look at America, see us funding all of these different, problems overseas, all of these different new infrastructure projects, all of these things we're working on, if they're not liking America, our position and the way in which we're handling things, they're very more likely going to continue to pull away from the dollar, meaning costs are just going to continue going up for Americans, right? Primary dealers, big banks who are obligated to finance whatever portion of the Treasury auction isn't purchased by other investors, bought nearly a quarter of the issuance, more than double their average in recent 30-year auctions, according to BMO Capital Markets. Waning demand for long-term treasuries rattled the stock market and bond markets in recent months before the Treasury Department offered a dose of relief with less aggressive borrowing plans than many expected. Today's auction could revive worries that buyers of U.S. debt will now require higher interest rates to step up. I mean, even the Treasury Department put this out right here, U.S. Department of Treasury. Demand for U.S. Treasuries may have softened among several traditional buyers. Bank security portfolio assets have been declining since last year, with bank holdings of Treasuries down $154 billion compared to a year ago. You look at what Jerome Powell said yesterday. Powell reinforces Fed's cautious approach towards further interest rate hikes. So this further guarantees that we're likely not going to see any Fed pivot anytime soon. Federal Reserve Chair Jerome Powell suggested Thursday that the Fed is in no hurry to further raise its benchmark interest rate, given evidence that inflation pressures are continuing to ease at a gradual pace. At the same time, in the panel discussion at the IMF, Powell did not rule out another rate hike to help reduce inflation to the Fed's 2% target level. Inflation is measured by the U.S. Consumer Price Index, has sunk from 9.1% peak last year, but is still just 3.7%. Now, to me, in my own life, the inflation rate last year is the same as it is this year. Probably even worse this year. So I'm seeing something completely different with my spending habits. I'm sure you're probably seeing some very similar things alongside me. Everything is extremely expensive, and increasing interest rates is not going to dampen this additional cost. At least if it is, we haven't seen any type of net benefit yet as an American consumer. Look at this building here. So look at this building, this skyscraper. How much do you think this skyscraper is going to sell for? So look at this. San Francisco is bad, but look at Los Angeles real estate market. This looks scary. The last major office sale in downtown LA was June, when this 334,000 square foot building sold for $40 million. This entire skyscraper sold for $40 million. In 2016, good economy, right? But not an incredible economy, not 2021, 2022, early 2022. It sold for $80 million. So it sold for half of the price in 2016, right? Now, one of downtown LA's biggest office towers has just hit the market after the owner, Brookfield, reportedly defaulted on $319 million in loans. What does this mean? These $319 million in loans are held by banks. You look at what is going on right now with American banks. We're walking into a very, very interesting situation that as we start to see bank failures continue to likely increase here in America, we had Silicon Valley, First Republic, Credit Suisse overseas, you had all these different situations that are happening. It's changing the perspective of risk. That's what's happening. And when you look at the amount of leverage and debt in the U.S. economy, you start to see a situation in which is going to likely only continue to increase interest rates here in America as these Treasury yields become more and more of a problem. Sources say it's expected to sell at a huge discount given the state of LA's troubled office market. It's unclear who's going to step in and buy this tower and at what kind of discount, but for downtown LA, it looks like trouble is just getting started, right? Almost 150,000 views. Then when you look at what's going on with credit card interest rates, credit card debt has reached the highest on record, almost $1.1 trillion in debt. And so they say right now that the average interest rate is 24.46%. So to put this into context, if you were to borrow $10,000 on one of these credit cards, it would be $16,000 in interest for $10K borrowed, right? $16,000. Now, as rates continue to rise, what does this mean? Well, let's look back at what credit card interest rates were just a couple years ago, around 17%. So it's 17% on $10,000 owed, you'd be paying $5,886 in interest. So as our interest rates rise, what this does to credit card debt and credit card bills, it changes this for on a $10,000 balance, 17%, from $5,800 to almost $17,000, right? So 3x the amount of debt owed, right? Oh, it's basically an $11,000 tax on just the difference in interest rates over, what has happened. So every time you hear about Jerome Powell increasing interest rates, just remember that this is directly going to cost, if you have credit card debt, you a lot of money. So 17%, $5,800 to $16,000, almost $17,000. It is absolutely shocking. But Fed reports shows that U.S. loan officers see tighter credit, weaker demand. Washington, banks tightened lending standards for U.S. businesses and households in the third quarter, but the pace of change appeared to ease and demand for loans fell broadly in a sign of impact of higher interest rates are having on the economy, Federal Reserve reported on Monday. The tightening of standards for business loans applied to firms of all sizes, the U.S. Central Bank said in its latest survey of senior bank lending officers, while consumers face tighter credit for home and home equity lines, credit cards, and tougher terms on auto loans. Now, I made this prediction 18 months ago. 18 months ago, I said, what's going to happen? Interest rates are going to continue to go up. Inflation is going to get worse. More and more defaults are going to be coming. Banks are going to tighten up because they're going to likely try to, batten down the hatches and try to reduce their risk. And that's what we're walking into. We're walking into a situation where I believe most people were anticipating this Fed pivot. I was never on that train. And I wasn't saying that to, scare people or, tell people, we're going to, be like a crash bro or any of that. You just look at the facts. You look at what's going on. You see things clearly. You're going to start to see things from a perspective and a lens in which many people aren't. And that is most investors are to their teeth in debt. Most investors are not in a position to bear this type of pain over the next 12 months. And most investors are going to be forced to sell in an environment where many buyers are, no longer able to buy because they don't have the credit, they don't have the cash, they didn't position themselves. But if you are looking to, invest in real estate, you're looking to make some really big moves, now's the time to formulate a game plan. I mean, when you have deals like this skyscraper, this looks like a $500 million deal. Like if you're flying out of LAX, you can look in downtown and you see this building. This doesn't look like, a $40 million property, right? This looks like a multi-$100 million property. But when you have all these buildings walking into a situation where many of which are going to have to get refinancing over the next year or so, you're going to see these prices continue to crash. This is going to have a net impact on small businesses. This is going to have a net impact on everything. So when you're looking at all this, I believe it's going to be a huge opportunity for smart and savvy investors. I think it's going to be the greatest wealth transfer in American history. I think a lot of fortunes will be made over the next couple of years. Real fortunes will be created over the next couple of years. I've always had this saying that, good money is made when everything is great, right? But fortunes are made during, when everything's bad, during the bad times. So we're walking into a situation where I believe many people that don't really have that much money are going to position themselves, make the right moves now, get into the right businesses, make the right calls, and they're going to put themselves on the map over the next couple of years. But it all comes down to making the right decisions and doing the right things right now. One of which could be, if you have bad credit, putting yourself in a position where you can get access to funding. You can go out there and buy and invest and make moves. Because as banks continue to tighten up these credit conditions, if you're unable to get access to money, it makes things a lot harder. So if you'd like to fix your credit, we'd love to help you. My company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description below this video, and I'll catch you in the next video.